Today, kicking into 2024, I currently have $50,427 invested in the ticker SCHD, the wonderful Schwab US Dividend Equity ETF. And as somebody that is not proponently a dividend-focused investor, somebody that is a total return-focused investor, I want to explain to you why SCHD remains a relative large position in the entirety of my portfolio, making up over 30% of my total investments. I want to talk about the concerns that so many investors raise when it comes to the double taxation on the dividends, the valuations. Shouldn't you just focus on total returns? And I want to explain to you how this fits into the future of my portfolio and where I expect it going in the next 10 years. And if that is a conversation you'd appreciate, damn it, just hit that like button, folks, because firstly, let's talk about valuation here. If we zoom out on the Schwab US Dividend Equity ETF, and I think if we take a look at a 10-year time frame, so probably from 2024 coming into, 2014 to 2024, we're up about 109% on capital gains. So this isn't the entirety of the return because there's crazy dividends and crazy dividend growth. The S&P over that same time frame, we're up about 154%. So there's a drastic difference. But again, where do those dividends come into play and what does that look like from an annualized return basis? Well, we can only really compare over a 10-year basis because VOO, the S&P has been around a lot longer. But since inception, which around 2012 when SCHD came about, it has returned about 12.56%. But on a 10-year basis, which is what we're going to compare to, it's only returned about 10.56, which is still an astounding return. That is a really healthy return. And on a 10-year basis in VOO, we're talking about a 12% annualized return over 10 years. So we're talking about literally 1.5 point difference. Now, over a 20 or 30-year period, that 1.5 points can drastically make a major impact on your total returns. And I'm going to explain a little bit more about that as we look forward. But just keep that in mind. Two of these returns are really amazing. So let's talk about valuation, right? Firstly, the price to earnings ratio on SCHD is only 15. In contrast to the S&P 500 that's trading at almost 26 times multiple. And I hear a lot of people say that the markets are overvalued. And if you believe that is true, you can use SCHD as a hedge. That is what I'm actually using it for, because not only is it less volatile, from the 2022 crash, SCHD only dropped about 18 to 19%, whereas VOO actually dropped, I think, around 24 to 25%, proving to be a lot more volatile just because of the tech stocks and the volatility that comes with that. But volatility equals bigger return. You can't get more return without more volatility. It's a very challenging thing to balance out, right? But just kind of diving a little bit deeper into that, I personally believe that, tech companies are going to continue to excel. They're going to continue to increase margin and expand in a way we've never seen in the past, from robotics and AI. And that is why the S&P should be able to trade at a higher multiple. However, if you believe tech's overvalued and it starts to sell off and correct, it's likely that money's going to rotate into the bottom half of the market where a lot of stocks that are comprised in SCHD are held. And that's going to start equaling some of the sell-off and the bottom half growth. So I'm not expecting some crazy sell-off or some crazy valuation correction back down to a median of 15 or something. But if that is something you believe, you should be looking at SCHD as a counterpart, because if money sells out of the big tech companies, comes into the lower half, SCHD is only going to benefit even more, especially into an interest rate cutting environment, because those are the kind of stocks SCHD is holding. And we're talking about fees, 0.06% versus VOO, which the expense ratio is 0.03%. For every 10,000 invested in VOO, you're paying $3. In SCHD, you're paying $6. It's not a drastic difference. It's not going to ruin your life. You wouldn't even notice that because banks charge more damn fees than that. But before I talk about my thoughts, how I'm utilizing this as kind of a hedge, let's just talk about the dividends and what SCHD is able to offer in comparison to VOO, because VOO is so kind of proponent to growth companies, and as growth companies passively weight their way to the top holdings, you're losing more and more dividend income. So the 5-year growth rate has only been 6% on VOO, and you can see that in the dividend history. You take a look at the 10-year growth here. You've gone from 78 cents to about $1.80 on the last payment. So just over a doubling, nothing too crazy, but very healthy dividend growth. Whereas SCHD is offering a profound 13.05%. And in that history, we're talking about a tripling of the dividend, right? Which is insane, from 25 cents 10 years ago to a whopping 74 cents today. Beautiful, beautiful, beautiful dividend growth, right? But again, don't just proponently look at dividends. That does not equate to the total return. It can really hinder the future of your performance, especially if you're looking to retire early like I am. So let's just talk about this real quick and what I think about these companies, because you got AbbVie, Merck, Amgen, and these all weighed around 4.3 to 3.8% of the top 10 holdings. Verizon, Coca-Cola, companies that I think are cheap today, companies that I think have a lot of growth moving forward. And as we cyclically see a lot of selling off of tech companies in 2024 shifting into healthcare, we're going to see the benefit in SCHD because industrials, healthcare, and financials make up the vast majority, with information and technology only making up 11%. Whereas if we take a look at the S&P 500 holdings, as many of you are aware, these have been fluctuating in the volatility, but you got Apple, Microsoft, Amazon, Nvidia, Alphabet. Again, there's Alphabet A and C, Facebook, Tesla, Berkshire, and ExxonMobil being probably the only large dividend payer in the S&P top 10 today. So I love both these ETFs dramatically, but I do believe there is risk of overvaluation in VOO. So you got to be a little cautious, a little careful. Past performance does not equal future return. But when I look at the expectation for future return, honestly, again, I know it's kind of shocking, but if you are a dividend lover, I think you're going to be probably pretty shocked with where SCHD is going to go, because not only is the valuation fair, not only are these stocks likely to perform better in an interest rate cutting environment, but you're going to also get that benefit of the continual companies that are focused on dividend growth. So if we take a look at the income details in here, guys, we can see that right now I'm getting about $1,968 projected over the year. And it's really nice because my annual yield is projected to be around 4.05%. And keep in mind, as everybody states, oh my God, I'm going to get double taxed on the dividend. Well, newsflash, every company that retains cash flow and earnings is going to pay an initial tax. They'll pay that out to shareholders, at which I hope you're not stupid and you don't hold it in a regular brokerage account, but this isn't a registered retirement savings plan. I'm a Canadian. We don't pay withholding tax on this. We're not paying any kind of income tax on the dividends, allowing me to reinvest it at a full rate of total return, which means if SCHD is annualizing over 10%, I am maximizing that annualized return until I withdraw it from this account. And as somebody that wants to fast track retirement and somebody that wants to draw against these dividends as I get to retirement, I don't want to have to take capital gains off the market. I don't know when the market's doing well or doing worse. I just want to be able to capitalize on the dividends, probably try and actualize across the entire portfolio with the S&P growth companies and dividend stocks around 3%. I want to be able to pull that out without selling any equity, and SCHD is going to allow me to do that. So let's presume I continue to invest maybe about $5,000 to $10,000 in this account a year, growing the stock. On top of that, the dividend continues to double or triple up. We could easily see my dividends getting me to about $500 a month within the next 10 years. That is insane. $500 US a month just within this one account. This is again, only 30% of my entire portfolio. There's a lot of huge potential with just in this ETF, and it is one of my favorite dividend ETFs of all time. And people that crap on it, I really don't understand it, because if you are a true value investor, it's probably one of the best value ETFs you can possibly buy. If you want lower volatility and less concern in your portfolio, or something to offer, more condensed performance and taking away some of the volatility, it's another great ETF as a proponent. But again, I'm not somebody that's stating this is an end-all be-all ETF. I would not put all my money in this ETF, as I do believe you need to look at total return over the lifetime of your investing. So I like investing in VOO. I like investing in individual growth stocks like Google, some of the Canadian bank stocks, et cetera, et cetera. It's just my personal opinion to believe this is not a bad ETF, and anybody that craps on it really just does not understand what they're talking about, especially if they're a value investor. But I'd love to know what you think in that comment section below.